A bank reporting double-digit credit growth and record-breaking profits usually signals a prime investment, but looking at top-line revenue ignores how that growth is actually funded. The state bank is replacing the loan-to-deposit ratio with a strictly enforced credit-to-deposit ratio, closing structural loopholes that allowed banks to hide true risk. This update strips away the accounting illusions. It forces banks to prove their lending is backed by stable, real-world deposits, triggering a rapid purge of systemic liquidity risks. Anyone pricing bank stocks using the old LDR calculations is looking at a mirage. They are valuing assets based on capital that no longer technically exists under the new framework. The metrics for banking safety have been rewritten. Evaluating these institutions through historical data will lead to significant mispricing. We cannot analyze Vietnam's banking liquidity without looking at the external pressure point, the U.S. Federal Reserve. By holding interest rates high, the Fed exerts immense gravitational pull on global capital. This creates an extreme stress test for the USD to VND exchange rate. The state bank faces a severe dilemma. To defend the value of the dong, they have to deliberately pull liquidity out of their own domestic system. They accomplish this by issuing T-bills. This action vacuums up excess VND, instantly starving the interbank market of the cash banks rely on to operate day-to-day. While retail investors expect the central bank to continuously pump cheap money to stimulate the economy, the actual mechanical reality is a forced tightening. Domestic easing can offer a brief gasp of air, but the global exchange rate is the ultimate ceiling on how far Vietnamese banks can grow. Historically, the state bank capped the loan-to-deposit ratio at 85%. This served as a mechanical brake to ensure banks didn't lend out more than they could safely cover in a panic. But the old formula contained a massive loophole. Banks could borrow short-term funds on the interbank market to legally pad their deposit denominator. Under the new CDR methodology, those interbank funds are completely stripped out. Without that padding, the ratio of loans to real deposits spikes immediately. At the same time, the numerator expands. Corporate bonds, which carry similar risks, are now added to the total credit figure, pushing the ratio closer to the danger zone. There is one sanctioned escape hatch. Highly capitalized banks can subtract their equity funding from the credit numerator, rewarding institutions with thick capital buffers. By eliminating interbank padding, the state bank forces these institutions to finance their loan books with actual, stable deposits from citizens and businesses. The original transition plan scheduled 100% of state treasury deposits to be excluded from the denominator by 2026. This trajectory would have instantly forced state-owned banks past their legal liquidity caps. To prevent a system-wide freeze, the government issued Circular 08. This acts as a targeted release valve, allowing banks to retain exactly 20% of state treasury term deposits in their funding pool. Vietcombank, Vietinbank, and BIDV each hold roughly 185,250 billion Vietnam in treasury funds. Keeping 20% of that total on the books provides them with a crucial mathematical buffer. Applied against the 85% ceiling, this retention directly generates 94,477 billion Vietnam in new lending capacity across the Big Three. In fractional reserve banking, base capital multiplies. With a typical system multiplier of 6, that 94 trillion base can generate over 566 billion Vietnam in new M2 money supply. Circular 08 does not loosen the rules for everyone. It is a precise intervention that hands the major state-owned banks massive lending capacity at zero marginal cost. Looking at the actual Q1 2026 balance sheets shows us exactly who survives the stress test of the new CDR math. This chart compares the raw liquidity ratios of major banks. Without the Treasury exception, Vietcombank's ratio would breach the ceiling at 86.17%. Because of Circular 08, their ratio drops to a perfectly safe 84.6%. The private sector lacks this advantage. Techcombank and ACB hold alls no treasury funds, leaving them with raw ratios of 132.8% and 124.6%. To push these ratios down to 85%, private banks must aggressively inflate their denominator by issuing expensive valuable papers. The scale is immense. Techcombank issued over 217,000 billion VND and ACB nearly 156,000 billion just to satisfy regulatory math. Every bank meets the ratio on paper, But state banks use cheap treasury funds, locking in a structural cost advantage their private competitors cannot match. When a bank relies heavily on expensive wholesale funding to pad its ratios, its top-line profit figures lose their predictive value. The true quality of a bank's earnings is determined by two factors: the volume of cheap retail deposits, known as CASA, and the percentage of non-performing loans. This chart compares balance sheet defenses. Vietcombank boasts a non-performing loan rate of just 0.57%, backed by a record-breaking loan loss coverage ratio of 274%. For every bad dollar, they hold nearly 3 in reserve. In contrast, Techcombank requires massive wholesale funding to operate, while trapping over 52% of its long-term loans in the real estate sector. High profits only translate to safe investments when they are shielded by massive loss reserves and completely independent of expensive wholesale debt. The regulatory landscape will tighten even further by 2028, with the mandatory implementation of Basel III standards, specifically the liquidity coverage ratio and net stable funding ratio. But the state bank has engineered an incentive. Any bank that voluntarily achieves 100% compliance with these standards early earns a total exemption from the 85% CDR cap. This exemption allows highly capitalized banks to fund mega projects without regulatory friction, while non-compliant competitors remain mathematically constrained. Exceeding these international liquidity standards grants an institution a decisive operational license to outpace the rest of the market. However, two specific triggers could shatter this framework and force a systemic liquidity crisis. First is the exchange rate. If the central bank is forced to issue hundreds of trillions in T-bills to defend the VND, the resulting spike in capital costs will crush the net interest margins of the entire sector. This chart highlights asset concentration. Techcombank has 26.44% of its total outstanding loans concentrated entirely within the real estate sector. A frozen property market halts the cash flow cycle, turning a stretched liquidity ratio into a direct threat to the bank's solvency. Extreme exposure to property or a severe currency defense will instantly strip away accounting defenses, leaving exposed banks fighting for survival. Navigating this environment requires a strict framework. Ride the circular '08 liquidity wave with the big three in the short term, pivot to Basel III compliant banks for the midterm, and constantly monitor the dollar and T-bill issuance. Capital must move from banks surviving on wholesale paper. Instead, seek refuge in the old fortresses, institutions armed with impenetrable reserves and cheap treasury deposits. Dissecting the mechanics of the CDR formula reveals exactly which banks are hollow inside when systemic liquidity dries up. Smart money positions itself ahead of regulatory shifts, securing assets inside balance sheets built to withstand the purge.